Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. And today we're going to be we're going to be summarizing a stock that we've received a subscriber request, SWBI, Smith & Wesson brand. So without further ado, today we're going to be looking at the business, who its customers are, a discounted cash flow model. We're going to be taking a look at the financial standing of the business as well as management, just the same old preliminary analysis we typically like to do. So without further ado, what are we looking at here today?
All right. So, we got this request at least a couple times, I think, right?
Yeah, I think it was about 3 or 4 separate times we got this request. Yeah.
And I mean, it's a company that probably everyone knows, even if you're not really a gun enthusiast. Smith & Wesson is a very famous brand. They're known for their revolvers, but today in the modern age, they make a bunch of different kinds of guns, ranging from rifles, shotguns,
civilian firearms mainly.
Yeah, pretty much civilian firearms. Yeah.
Yeah.
So I guess one thing that I can kind of talk about is some people might think that this industry or business is controversial, and that might attribute to its perpetual cheapness. That may be true. For example, there was a trade that I wasn't personally engaged with it, but I was working closely with those who were in the coal mining industry. And that one was one where the sentiment was very negative. I don't know if some of you may have been investing during that time, and you may have been paying attention to financial news, and BlackRock had recently dumped all of its coal mining stocks. And among those, there were a couple that were what we thought were very valuable. And then we picked up shares while BlackRock was dumping them. And then we did okay. My personal portfolio wasn't involved in that, so I didn't benefit directly from that. However, that's kind of like the same idea. It was a company or a set of companies that were considered to be controversial, and their price action reflected that controversy or that sentiment. And so we talk about on this channel a lot regarding sentiment-driven price action and fundamental-driven price action. And you have to be able to identify when which one's happening right before your eyes. So without further ado, as we always begin with these, I'd like to talk with our audience about the price action, right?
Nice. The price performance. I was about to ask that. I was like, Fabio, where's the price performance here?
Yeah.
It's the capital mindset standard. We always start with the price performance.
So if you see over the very long term, Smith & Wesson has actually been a good company, but you have to kind of pick it opportunistically. So right here, one thing we can observe is if you had bought it at IPO, let's see if it drags perfectly, you've done very well for yourself, right? So since the beginning. And then again, these troughs, when it bottoms out, you've done pretty well. If you don't even pick the bottom, let's say you picked, down here again, and then what causes these massive spikes? It appears cyclical. That's what I want to highlight, by the way.
Well, something else that I kind of want to highlight too is we see this massive spike between 2020 and 2021. And as many of you know, there was a lot of social unrest in the United States specifically. So I think that probably contributed a lot towards the sentiment here in Smith & Wesson's, especially in regards to this. Because I know when I was looking at this particular company, this was definitely something that piqued my curiosity. I was like, why did they have such a significant run up like this? So now, sort of where my mind was going to go with this, at least a preliminary idea, is this potentially an investment that I could hedge a bet on further social unrest? Is this potentially an investment that I could stand to capitalize in some way from further social unrest? I know it sounds terrible, Fabio. It really does, but I'm just trying to stay objective and just sort of looking at what I'm seeing here. And that's just sort of the pieces that I'm already starting to put together in my head. So what are some of your thoughts regarding that?
Well, what you're describing is a tailwind that sales will benefit from, people being afraid of for whatever reason, and then they go purchase a firearm to defend themselves.
Yes.
Yeah, that can be the case. Okay, maybe that's the case, but what we want to pick our battles, right? So how certain are you that that's going to be the case?
Yeah. And I don't entirely know with certainty if I could even make an assumption of if that would be the case or not. So,
Yeah. So, I mean, that's something for us to think about. We don't really know if that's going to continue. We know, all we know is that it's the company has benefited from that in the past
yeah.
regarding 2020 and 2021, but going forward, we don't know if necessarily that will be the case. All right.
Yeah.
So what we want to look for here is a margin of safety to kind of express our uncertainty. Now, before we begin, I don't know if everyone saw, so I'll actually bring it up right again here. According to Google, the P ratio is 3.28. We don't really die on the hill of PE ratios on this channel.
Yeah.
Uh,
Especially not forward PE, especially
oh,
not forward PE.
I know who you're digging against, but so the P ratio, it's very cheap. So on a GAAP net income basis, the company's cheap. I would presume that on a cash flow basis, it's also extraordinarily cheap. So what we're going to do is just hop on right over to the model and ignore right now what it's telling you in terms of buy and don't buy. We're rating it at 0% growth rate. And what we can see here is analysts have a buy rating. Let's first talk about the almighty analysts with a price target of 27.25, implying a 52.9% upside. Now, if you want to just trust them, there you go. That's the analysts. And then looking over here, I can see right here market cap of 860 million and enterprise value of 700 million. So right off the bat, I can tell that they probably have more cash than debt. Now, I want to take a look at some of
Well,
these.
would you also kind of elaborate on that maybe for some of our newer audience as well? Like, what is it about enterprise value and market cap that will tell you if respectively if it has more cash than debt or if it has more debt than cash? And what if so, is this sort of a little smell test that you typically perform when you're
Yeah.
first doing a preliminary analysis in this instance?
Well, it's something that I can pick off pretty quickly. So I can see, for example, that the market cap is 860 million. The enterprise value is simply the excess cash, and you subtract that from the market cap, and then you add on the debt. All right, because in theory, that would be the price, the total actual cost of the business if you were to buy the whole thing. And then assuming that you would probably distribute any excess cash to the people you're buying it from, and you would take on all the debt, so that adds into the cost of the business. So when you're using EV to EBITDA, that's what the point of that is really.
Mm-hmm. Okay.
But looking at it from that perspective, it quickly tells me, okay, they probably have more cash than debt. So I'm going to take a look at some of these numbers and I'll kind of explain what it is. So right here we have, we'll actually do some growth rates later, but just to cover some things here, this right here, debt heavy. The model is telling me debt heavy, but it's not really debt heavy because the thing is this company's been buying back shares and hasn't been using debt. So,
Okay. So that's
share
sort of an
issuance
added
is
nuance.
negative.
That's sort of an added nuance applying the art to the science in this instance then. Okay.
Well, it's telling me what they're using more of. They're using zero debt and then they're using negative stock.
Mm-hmm.
So stock is still less than debt. So the model's telling me they're using more debt than stock. Does that make sense?
Yeah.
So in their cost
sense.
of capital structure, they're not using either stock nor debt to fuel future growth. They're buying back stock and they're not taking on new debt. So the model is telling me that they're quote unquote debt heavy, but I'm adding that extra layer of information so that people don't get confused and think that they're utilizing debt. No, what the model is measuring is there's a greater use of debt versus stock. Why? Because debt is zero and stock is negative, and zero is bigger than negative. So that's what that means. And then they're buying back shares. We can see here on an average of 2.78%. Again, I'll cover these other metrics in another video once they're fully implemented. But for now, let's keep it at a discount rate of 20% because I said before, with a company like this, to add for these uncertainties, I'm going to require a heftier discount rate. One thing I should keep in mind, I've normalized myself the cash flows. Okay, so the cash flows right now, they're projected to decline because of the fantastic year they've had. And if you use the cash flows of 2021 and you just presume that they're going to grow, I've seen a channel that presume that. I don't agree with them.
Well,
That
let's kind of explore that now. Why don't you necessarily agree with them in this instance here?
well, because if you take the average cash flows over the course of the, I think the last 6 to 7 years, excluding the pandemic, what the cash flows are now is almost triple the average. So that goes off of the highest margins this business has probably ever seen in the past decade. So they're keeping more of the sales revenue. So that the dollars that, in sales figures, they're keeping the most that they've ever done, right? The margins have expanded. They might have come down from 2020, but you know what? Actually, let's take a look at the ratios to kind of showcase this. So yeah, you can see here in the margins are growing, right? They're the highest they've ever been. They've been growing. Now you may make the argument that they've been growing before the pandemic, true, but now they're on another level. And net profit margin is just simply on another level, right? This is a perfect example of what I'm talking about. Margins are extraordinarily high. If you believe that they're just going to continue willy-nilly as they are right now, that's an assumption that you're making, and good on you if you're right, but I'm not comfortable making that assumption. You believe that they're going to stay away from those low margins going forward into the future when things normalize, instead of they're going to keep these really high margins. Okay, well, that's an assumption. And then the return on assets is, again, look at that, extraordinarily high. By the way, I said that without even looking at this. I'm looking at this for the first time with everyone. I have not seen the key ratios, but I was presuming that they had the highest margins ever because from personal experience because we all lived it. The gun sales in the United States were doing really well. People couldn't find ammo, stuff like that. So that goes immediately to that they were able to probably get the highest margins ever. And I'm seeing them right here in the numbers. The numbers are telling me that.
Yeah. Well, I mean, also let's kind of contemplate the idea that there might be a potential serious tailwind as well for the future of gun sales in the United States too, because I think that's where a lot of these YouTubers that's the hill by which they're willing to die on when it comes to Smith and Wesson. They're saying, okay, well, we're seeing an uptick, we're seeing an upwards trend in social unrest that contributed significantly to firearm sales. We're also seeing too that there's a significant gun culture in the United States as well. That also contributes to firearm sales.
Been that.
Therefore,
there's always been that gun culture. No, they didn't have enough to go around, right? They couldn't produce enough.
Yeah. And now my kind of question is too, and this is actually a legitimate question. What is the risk that the government of the United States, when the Democrats are in office, let's say, what is the risk that the government of the United States could pose to a company like this specifically? And then if so, is that definitely something that significantly impacts our margin of safety here?
Yes.
Okay, cool. Nice.
Yes.
Yeah.
Yeah, that I guess from what you're trying to guide me into, I would imply that it would require a higher margin of safety because of added political risk. I mean, the United States has those things called amendments and stuff, and for as long as they're strong or whatever, that maybe this company can sustain its presence. But if you look at other case studies, like for example in Europe or Spain, Spain had actually a lot of gun manufacturers that are actually pretty much dead, or at least I think completely dead, and then the Germans basically dominated that market within Europe. So government can come in and actually kill industry. Yes, that is a risk, to answer your question. But whether or not I would say that would be the main focus of the risk. My main focus of the risk would be normalization of margins. So if you want to not look at the political side and then stick to the what could happen if just things get back to normal, or what will most likely happen is things get back to normal, not just everyone being peak pessimism or peak, you could say, scare. But I don't even, you see, like, because I don't want to ramble, but it
No, it's
wasn't
fine.
so much
Yeah.
peak scare. It was also scarcity of the product. Does that make
Yeah.
sense?
Yeah.
So it won't be that scarce going forward. And that being said, that would probably be reflecting in the margins going forward. So if those margins come down, these cash flows are not going to be sustainable. They're probably going to normalize. I've normalized them for the sake of this model today. I've actually, if we're being honest, I've made it higher. So I've actually been quite generous. All right. But the problem with a lot of, I saw another content creator make a video about this company, and they were discussing or showcasing in their formulations that the business would continue going forward from the current numbers. I think that's very flawed. And whoever's following them into this investment may end up getting a big surprise because they touted it as an extremely cheap
Might be
opportunity.
falling into a value trap in essence. That's what you're
Oh
basically
yeah,
trying to
that's
say.
actually the perfect. Thank you. That's the perfect word.
Yeah.
This is actually a case study of a potential value trap. I don't know because I haven't actually gone through the whole thing yet.
Yeah. This
I
is
just
also a preliminary analysis done live. So also saying that as well.
yeah,
But please continue along
I'm
the train of
always
thought that you currently had.
I'm always skeptical, kind of like what Howard Marks says, when something is too good to be true, it probably is. I'm always skeptical when something shows up and it's extraordinarily cheap.
Mhm.
I understand that, sometimes it is extraordinarily cheap, but I'm always skeptical and I try to find out why is it cheap. And now I'm kind of seeing it. Remember, a good investor, a good finance investor looks at the numbers and takes a story, derives a story from the numbers, not just looks
Yeah.
at numbers and then just says, oh, ooh, ratio go up better. No, you got to tell a story. So right here, the story is telling me that the margins have just blown up. And now I have to then, going forward, assume whether or not the margins are going to maintain themselves or come down. Okay. So let's look at some activity ratios. And again, we see the same story. It's 2020, 2021. We see the cash conversion cycle, the
Yeah,
best that it's ever been.
that's a pretty exceptional change. I do have to note that. Wow.
You should note that. So this is where I'm
Yeah.
trying to say to our audience watching, we're still a small channel. So not many of those people who watched that other channel will see this video, not many of them. So for those of you who may have seen, videos about Smith & Wesson, how cheap it is, hopefully you take, you also take this perspective in mind.
Let me make sure that I'm understanding what you're saying here correctly. Just to summarize, to make sure that I can kind of put myself into the audience's mind right now.
Yeah.
We need to be careful because a lot of the other content creators making videos about this are assuming that what has happened in 2020 and 2021 will continue. Typically, what we like to invest over the next 10 years. What happened in 2020 and 2021 will continue over the next 10 years. Meanwhile, what you're saying is that you potentially believe that 2020 and 2021 were exceptional years for Smith & Wesson. However, it should regress back down to 2017 levels as reflected in their margins, as we're seeing here in their activity ratios. And because of that, you think that there could be a potential value trap here. Am I understanding this correctly?
I think it will regress back to trend growth. I do think that they were growing, but it will regress back to trend. Okay.
Okay.
So that normalization period will see a decline in margins, decline it pretty much across the board. And then you're going to be caught holding the bag and not understanding why. And I know that we got to make sure. Well, I already know the answer to this actually, because I was, quickly briefing over some news about this business. And I saw that management was, indeed selling some shares. They get stock-based compensation. They are buying back more shares than what they are diluting you by. So there's a net negative stock issuance. So the management team, they're going to be just fine. It's the investors who are buying now that think they're getting a very cheap company may be in for a surprise.
Keyword is may. Yeah.
Yes. So let's take a look. Okay, so right here, everyone, key earnings quality right here. My
Would you kind of
indicator.
explain, yeah, what earnings quality is? Just a quick, like 2 sentence explanation for maybe some of our newer audience here.
Yeah, so earnings quality is something I like to use a lot. It's a unique thing that I personally use to kind of measure the quality of earnings being given out by management, and it's like a grade. But we've discussed in previous videos how it sometimes quite a bit correlates with the performance of the business. So when we saw earnings quality improve, we saw performance improvement, right? Correlation. And good earnings quality is simply the absolute value above one. Okay. So if it's negative, change it to a positive. And then if it's above one, great. And then if it's positive, you don't have to do anything to it. But for example, right here in 2021, we see a deterioration. And so that's not a good sign right there. So right there, that's not an X immediately, but that's a red flag for me. And that's a unique measure I like to use. Book value per share, I actually would care if it was trading below. It typically has traded below book value. And right now you're buying above book value. Okay, so I'll remind everyone, that's why we look at the price action in the beginning of the video. And we can see here in 2019, you could have bought this thing for $4. 2018, you could have bought it probably at book value, and it was above book value in 2017, but you had that deterioration. So I wouldn't be surprised if we saw the price action actually return to around $7, in which case this could be an interesting play, by the way, because I think underneath the hood, there is a very solid business. It's just the numbers are maybe a little misleading. And I use the word maybe because also maybe not.
Yeah, there's really a gray area with this. That's why even though you're formulating the opinion that this could be maybe, keyword maybe, a potential value trap, this is also a maybe too. What if that isn't the case here? Then let's assume that this isn't the case. What are we looking at here today? Are we looking at a very solid business that has the potential to continue to grow from here? Would that then give credence to the other YouTubers and what the other YouTubers have been saying? These are just some thoughts that I have racing through my mind as I'm kind of going through this preliminary analysis with you here. And then I hope the audience is also thinking about this kind of stuff as well. So
yeah. So, I mean, right now, this company's really cheap. You could see right here, if they dedicated 100% of the cash flows, excess cash flows to buybacks, they could buy back 15% of the business. That's how cheap it is right now. But the problem is, how cheap will it be going forward? Are the numbers just going to stay like this? And then think about this. What is management doing with all that cash? There's no debt to be paid off. The CapEx is already taken care of. What are they doing with this cash? Why are they not returning, shareholders? If the stock is so cheap, they could be buying it back nearly 15% of the business quite easily. And again, this is with normalized cash flows. I was being a little bit generous, but it's less than what I estimated from what 2021's numbers have been. So I've normalized it, but I've been generous. Okay. So I didn't, go back to like the average. I gave him a little bit. All right. So let's take a look at what some growth rates would look like. So if we assumed a 5% growth rate, it's not a buy. We would have to be buying this thing at $15.67. We are assuming a 2% buyback going forward for the next. We have to actually change this to a 10-year. So now we're good, because now when we're looking out the long end of the curve, it's we actually can assume a 5% growth rate. However, I am still being generous, right? I'm being very generous.
Yeah, I was
about
to ask you if you actually wanted to now even go into the data dump portion of the model and just sort of play out your hypothesis. So normalize the cash flows to 2017, 2018 levels, and then sort of re-put this back through the model again. And we can kind of just see what's going on here. Just really interested to just sort of see if your value trap theory, how that would look and how that would be reflected in this model.
If I went, for example, back to like 2019 numbers,
or like 2017, 18 numbers is what I'm talking
18
about. Maybe even
really
2019.
Bad. Yeah, 18 is really bad. 2019, they were actually rising up again. I think 2017, was decently bad. And then 2016 was, 2016 was good. And then 2019 was basically rising again. So if I put it back to 2019, I'll take everyone back so we can see that together.
Yeah.
But if I kind of revert it back to the norm, and I'm not being generous now, this is me not being generous. This is me saying it's going to revert back to the average. So taking into the average, excluding 2020 and 2021, this is what we're looking at. I'd have to assume a decent amount of growth. Remember that this is misleading. Why is that misleading, Austin?
Because of 2020 and 2021's numbers.
Thank you, sir. So we can't really, if you want to assume the 11% growth rate, you still can't do it with that margin of safety, because I would require that margin of safety. And I'm assuming buybacks, right? I'm assuming some buybacks. If I think they will do buybacks. They just started a dividend, but let's see with not that high. So with a 15% required rate of return, you still cannot assume the 5% just yet, but you're basically there.
Yeah.
It's just not the margin of safety I would want, because I actually don't think they're going to grow at 5% compounded for the next couple of years. I would actually lean more on the 1% and maybe a slight decay, because again, we'd have to kind of think about what the effects are of the demand pull that occurred. Okay, so that's why I require a higher margin of safety here, because of that uncertainty. I don't know how it's really going to play out. If you look at past cycles, typically when the political party that is thought of to be anti-firearms takes power, sales rise and then it kind of collapses. And if the party that is thought of to be more favorable to firearms wins, the sales collapse relative to the other times, right? So you have to think about that, right? And if we go based off of the cycles, and you think this is it, that's where it peaked off, I'll go back and kind of look at some examples. If we go back to the max chart, you can see here, this is probably reflective of the peak cycle of the Obama administration. Look what year that is.
Yeah, it's 2016.
Exactly. And then you had the glut. The Obama administration lasted about 8 years. Right. And then we're already about where it was. We are where it was back then. Okay, right now. So you see, if I'm going off of that, you're kind of buying probably at somewhere close to the highs.
Yeah.
Remember that the gun market in the United States is very mature. If you talk to gun guys, they'll even tell you. I've spoken to a couple in preparation for this video, and the business of gun making for the masses is a bad business. It's a low margin.
Like the real profits are in the military firearms, I've heard.
Yeah, no, not I've heard. I told you that.
Yeah. Well, yeah. I also heard it too. But I think when it comes to civilian firearms, correct me if I'm wrong, there's multiple different manufacturers as well. And it's characteristically lower margin than would be military firearms in this instance too. So that's just something else to kind of keep in mind with a particular business like this. So
well, I mean, because a lot of the designs are not patented.
Yeah.
So it's a commodity basically. So like for example, many people don't really know that, but the AR-15, it's a weapon design and anyone can really make it. It used to be a long time ago exclusive to a company, but it's no longer. Anyone can really make it. I think Smith & Wesson makes their own version of it. So but that's just one example. I mean, all these guns, none of them are really patented, so the margins are really low because you're basically, it's a monopolistic competition basically.
Yeah.
So you just have branding power, and then that's it. And even among the gun people, I mean, there's a lot that do care about brand, but for the most part, new entrants into the market don't really care too much about the brand. They just care that it works, does what it needs to do, looks cool, stuff like that. So
Mhm.
it's a terrible business. It's not a good business. So you have to buy it at the right price if you really want to get into something like this. It's not something that interests me right off the bat, but it is something that if I see it at a very good price, I wouldn't say no to it. I would
Yeah.
definitely be interested in it. But at these prices, I think the analysts that you see, like the problem I have with analysts, I'll just say it. They go off of a lot of the momentum. So stock rises a lot, they change their price targets to be higher. And then their estimates rise too, so that they don't look bad. And then the stock price collapses, they'll make their estimates lower, so then they don't look bad. At the end of the day, they just want their paycheck. Not all of them, but that's why in the analyst community, it's a very select few that are really good. All right. And then those are the only ones you really want to pay attention to. But like, you got to find them. But there are really good analysts out there. I'm not saying there are no good analysts. There are really good
Yeah.
analysts
Yeah.
out
It's
there.
not
But
like a black and white statement. There's definitely a gray area with this thing. It's just the majority tend to, you know, rely off of momentum and copy each other, as
yeah,
you've said
it's
before.
kind of like how in other videos I not ranted, but I dragged through the dirt journalist majors. Well, it's
Yeah.
not that I think all journalist majors are bad at what they do, or I don't know. Oh, but there in history, there's always a select few that are fantastic.
Yeah.
For example, in journalists. So there you won't remember most journalists, but you'll remember a select few who've changed, the course of history because of their journalism, right? They've done really great work, and you won't remember the vast majority of them. All right. So same thing with analysts. They're kind of like the same thing. Analysts in a lot of ways are journalists, and they're the finance journalists in some ways.
Yeah.
But
Hmm.
with that being said, what are your thoughts, Austin? So we close off and
I think the business itself is actually really interesting. Sort of what I'm looking at here. I'd lie if I said that when I also watched this other creator's video, and then I was also kind of doing my own research on the side, I had not exactly considered your hypothesis of this potentially being a value trap. My mind was primed coming into this. Okay, continuing social unrest in the United States. I saw this huge explosion in sales over 2020 and 2021. Therefore, I could probably hedge my bets that that same explosion might occur in the future should there be more specific political unrest. But your hypothesis about this being a potential value trap, I actually found really intriguing. So that's kind of given me food for thought. And I've been sort of pondering that since. But those are sort of my closing thoughts here today. Do you have any before I wrap up the show here today?
well, I'll kind of add to that. Some things that we want to I'll highlight is you've utilized the copy of the model that you have, right?
I
And
have. Yes,
and it told you very positive things, right?
it did. Yes,
So, this is kind of a good lesson as to that it's a tool. It will never
it
make
is. You
you
should
an
never make
investor.
yourself a slave to the model.
Yeah,
you
but
know,
I mean, this is also the purpose of videos like this. It's to put it out there for educational purposes that you gotta think about nuance. So this business, it went through something unique, and then you got to think about whether or not that will continue. And if you become a slave to a tool and you don't think for yourself, then you could end up making a big mistake. And this is one of those. Now, I will always do my best to try to implement some parts. Yeah.
yeah, something I actually want to add on to that too. And it's not even really a counter, it's just another kind of thought that I have. A lot of people typically tend to like to use tools because they feel they might make too many decisions out of rash emotion, and therefore using tools, having specific percentage allocations in their portfolio for their portfolio strategy, for example, let's say, using specific tools in that instance helps them sort of get rid of the emotion here. I don't actually think that's what you're saying here, but I wanted to
No.
just sort of add this point in just in case there might have been a misinterpretation with someone listening to this. We're not saying tools are bad. What we're saying is tools are tools, but at the end of the day, you still have to use your brain and you still have to pretty much trust yourself with the decisions that you really make. But please continue with
No,
what
I
you
mean,
were
I
saying.
wouldn't say tools are bad. I created the model to be a tool. So I poured basically a lot of my thought process into the model to automate certain things that I would normally look at for companies. And then I utilize that in my investment strategy. So I think what I'll do specifically for that is I'll use basically some broad statistics in the background to kind of try to mitigate that when we release the final tool for everyone on our website. Well, on our new website that we haven't launched yet, but on our new website. And it will basically, hopefully, highlight to the user when something may require the human touch to like look at more closely, say, hey, this may be like a unique event that's going on here. Please confirm before you input your growth rates, right? Or please confirm before you utilize the trailing 12 months cash flows or the last year's cash flows. Because, I mean, I've seen some, again, we're not going to mention which creators it was because we don't want to badmouth them, but they used in their models the current cash flows, and then they continue to assume growth from here, which I think that's very detrimental in terms of doing a quick analysis. I know that, they might not say that, oh, you need to do a deep dive right now. It's just a quick look. Well, it took me seconds. I haven't done a DD in this business yet. It's just kind of like, I would say, quick common sense, right? That's all I'd say.
Yeah.
I mean, we did this live. This is the amount of time that I've really put into really looking at this company.
Yeah. And it's sort of interesting too, because I know, at least for me, like when I was first learning how, and I'm still learning how to invest, but like when I was first going through it, I would see these radical disparities in numbers and I would dig deeper, which is exactly what you should do. And then what I kind of came to the realization of is that some quarters you're going to have these just wild quarters where the business brings in a lot of cash, and then other quarters where it's not
but
a
that's
lot of
normal.
cash. Yeah. And but basically the point that I'm trying to make is, let's say that they have a year where we're seeing something like this, where they have an exorbitant amount of cash coming in. Their sales are absolutely incredible. The point that I'm really trying to make here is that it's important to use your own mind and sort of come to the conclusion, come to the assumption, come to the determination of if this is a one-time event or if this is a continual increase, if the trend is increasing upwards in sales. That's basically what I was trying to say without all the rambling aside, but
Yeah. But because I don't want the audience to get confused, what you were describing there is, fairly normal for a lot of businesses. For example, Apple is like that. Apple has a quarter, the fourth quarter of the year is fantastic for Apple. And then I think Amazon as well. So the other quarters pale in comparison, or I think maybe Amazon's first quarter is really good too. But Apple for sure has one quarter that's absolutely blows it out of the park, because that's where everyone buys all the iPhone. The iPhone releases in that quarter. So you would see that, but you're talking about yearly cyclicality. Something.
Yeah, I said quarter, but I meant year. Yeah.
No, but even like, so you're saying 1 year yes, 1 year no. There's a lot of businesses like that, but what we're describing is something that's longer term, a bit more cyclical. Something like oil companies. Oil companies are like that, or copper companies, stuff like that. Commodities.
Yeah.
I mean, in some ways, civilian guns are commodities in some ways. So, I mean, I think to summarize everything, to close off so everyone can just, hear the final thoughts. I think there's more to this business than meets the eye. At the right price, it's interesting. However, I think right now it may fall under the value trap category for me. It doesn't, at the current price, it doesn't fit that necessary margin of safety. It looks extremely cheap in the current form, but I think that's misleading. I really, really, really think that's going to be misleading to a lot of people, and they're not actually thinking about the normalization of the margins, because I don't know if everyone really caught the meaning behind that, right? If the margins come down, Austin, the margins right now are really high. Okay,
Yes.
the cash flows are high, the margins are really high. If the margins normalize, guess what happens to the cash flows?
Cash flows will end up going down.
You don't even need revenues to come down. You can have sales stay the same, margins come down.
Cash flows go down. Yeah.
Yes. So sales don't even have to come down. But if sales come down and margins come down, guess what happens? Big
Cash
drop.
go down. Yeah.
Yeah. Cash go down. I love that. Cash go down.
Yeah.
If that's the takeaway, people have cash go down. Yes.
Yeah.
So
yes.
This is kind of like this gets my sticker, my caution sticker. Okay.
Fabio's giving this his caution sticker.
Yeah.
He's giving SWBI the caution sticker.
Exactly. I won't be investing in this, but that doesn't mean it's a bad investment. I would just, for me, I'd be cautious. All right. That's my thoughts.
All right. Well, with that being said, we are your hosts, Austin and Fabio. We hope that you've enjoyed what you've seen here today. If you have, please be sure to share the video. It really, really helps out the channel. Please be sure to follow our Instagram and our Twitter at capital_mindset. And then also like, comment, and subscribe. We are your hosts, and take care, guys.